The major stock indices hit lifetime highs last week and then reversed course at week's end. Tech stocks tumbled, dragging the Nasdaq lower after months of outsized gains. Investors brace for September, historically the most challenging month for the markets amid looming Fed decisions and inflation data. I'm Charles Brown, and welcome to the weekly CB3 Financial Update, and it starts now. So last week began with optimism as the S&P 500 crossed the 6,500 mark for the very first time in history on Thursday, securing its 20th record close of 2025. The Dow and Nasdaq also notched new highs, buoyed by a combination of strong earnings reports and the expectations of a dovish Federal Reserve stance following Chair Powell's remarks in Jackson Hole. I'm not so sure that those were really encouraging words as I think back on that speech, but I believe we have 1, 2, maybe 3 interest rate cuts in store for the rest of this year. Despite these milestones, though, Friday brought a reality check. The S&P 500 dropped 0.6%, while the Dow dropped 0.2%, and the Nasdaq slid by over 1%, erasing much of the midweek gains as investors took profits. That's not unusual because it's ahead of a holiday weekend, which we just finished on Labor Day. Lower volumes obviously contributed to the reversal. Whenever you're heading into a holiday, the volume in the stock market tends to dwindle. And with notable losses from Dell, Marvell, and even Nvidia, which saw its first monthly drop since early spring. Sector-wise, though, technology grabbed headlines early in the week, energizing the rally thanks to enthusiasm surrounding artificial intelligence and robust earnings, which I will tell you more about on the September CB3 live show a week from Thursday. By week's end, a visible rotation was underway with energy and defensive stocks showing resilience while tech gave back some ground. Meanwhile, gold broke a 3-week slump to close at a record 3,473, and the yield on the 10-year treasuries ticked higher after trending down earlier. We want to see that yield go lower so that interest rates drop for everything in general, but most particularly for home mortgages. The Federal Reserve's preferred inflation measure, Core PCI, ticked up to its highest annual rate in 5 months, adding just a hint of unease about the policy path ahead. Still, what I said earlier holds. We're going to see 1 or 2 and possibly 3 rate cuts before New Year's Eve. August as a whole closed with strong gains. Remember that August is usually the second weakest month right after September. So that's a positive with August closing with strong gains. The Dow was up more than 3%, the S&P up 2%, and the Nasdaq about to, capped by 4 successive months in the green for the Dow and the S&P. So the highlights from last week's trading, all-time highs in the indices on Thursday, especially the S&P 500. That 6,500 was a key level of resistance, and the market did close above that one day and then sold off pretty hard on Friday. But it's underscoring the still resilient bull market. That's how we're trading it. We are still fully invested in all of our programs. Earnings season wraps up with tech in focus, but signs of slowing growth for artificial intelligence stocks, notably Nvidia, raise questions about how much further the sector can push risk assets. There are other sectors, of course, other than technology, but for years, technology has been the bulwark and leader of the pack. Economic data turned heads with an upward revision of Q2 GDP to 3.3%. That is a big number. 3.3% gross domestic product is more than most pundits were expecting, and a hotter core inflation print narrowing the path for future rate cuts as speculation builds ahead of September's Fed meeting. And I've been saying in this broadcast that it's expected that they will cut in September. They may not cut again the rest of the year, but they pretty much have to cut in September. Friday's retreat highlighted the market's sensitivity to sector rotations and profit-taking after a sustained rally, as well as jitters over politically charged news around the Federal Reserve and changes in the U.S. tariff rules. We still have tariff tantrums playing out in the market. So let's look ahead to September's challenges We know that when we turn the calendar to September, we're going to face volatility and probably a down month because more than 50% of the time, September does close lower. Thus, Wall Street faces its most difficult month statistically. So over the last 3 decades, the S&P 500 has averaged a September decline of 0.7% with a negative monthly print in 4 of the past 5 years. Yet volatility remains historically muted. So this year could be an outlier for the positive. I would say the other way, that it's kind of eerily calm right now with the VIX very low and no 2% S&P 500 drops in more than 90 trading sessions. So this week and next, several critical catalysts will test the markets. The monthly jobs report, a key inflation reading via the Consumer Price Index, and the highly anticipated Federal Reserve rate decision, all arriving within the next 14 trading sessions. Our CB3 Live monthly show in September will be about in the middle of that. Be sure to put that on your calendar Thursday night, September 11th, 7 p.m. Central Time. With the futures markets pricing a roughly 90% chance of a rate cut, traders and investors are preparing for potential turbulence as these data points hit and policymakers hold their press conferences. So expect cautious positioning, especially in tech, and keep an eye on the rotations as Wall Street navigates tariff changes, political headlines, and the usual September headwind. Thanks for tuning in to the weekly CB3 Financial podcast. We'll be back in a week and then again next Thursday night, September 11th. Don't miss the monthly show where we'll talk about all of this in greater detail. Thanks for listening. See you next time.